The building should have been dark on a Saturday night. Instead, every other floor in the financial district, this most heavily guarded tower, is lit up like a trading day that never ended. Chauffeured cars have been rolling into the underground garage for hours, some without plates, most without logos. Security staff, normally bored and scrolling through their phones, are already on edge from the second wave of badges they've never seen before. No press, no public statement, just a growing sense that something is very wrong. On the 31st floor, a Bloomberg terminal screen shows the one number everyone in the room keeps drifting back to. The last traded price of silver futures before markets closed on Friday, $42.37 an ounce. 48 hours earlier, it was trading at $34. A month ago, it was under 27. 6 months ago, it was still in the low 20s, an afterthought compared with the headlines about AI stocks and tech IPOs. Now, in less than a quarter, one of the most ignored assets in the world has gone vertical, and there is a credible path, if nothing breaks, to $80 in the next trading week. What triggered the meeting wasn't ease, just that silver had broken out of a decade-long range and smashed decisively through its old 2011 high near $50 in after-hours electronic trade on Friday. Markets can be wild. Commodities spike all the time. The panic stems from something more structural, the growing realization that in a market where hundreds of ounces of paper silver are traded for every ounce that actually exists in accessible form, too many people are suddenly insisting on delivery of the real metal. And the inventories that everyone used to assume were basically infinite now look suspiciously finite. Fact trumps rumor here, and some basic numbers are sobering. Across history, the world is estimated to have mined roughly 55-60 billion ounces of silver, but most of it is dispersed in old electronics, solar panels, medical equipment, and destroyed or lost coins and jewelry. Estimates of investable above-ground bullion, coins, bars, and ETFs that could realistically be delivered come in at only a few billion ounces. Global annual mine production is on the order of 800-900 million ounces, while annual demand has recently exceeded 1 billion ounces, with several years of structural deficits where consumption outpaced new supply and recycling. The Silver Institute has repeatedly flagged that the market has been running shortfalls, plugging the gap by drawing down inventories. Overlay that with leverage. On a typical day, futures exchanges like COMEX might see trading volumes corresponding to hundreds of millions of ounces in contracts changing hands, dwarfing the physical flow. That is normal for a modern derivatives market. Far more paper is traded than ever moves in trucks. As long as most market participants are content to settle in cash or roll contracts, the system works. But the system is only robust so long as the belief holds that if you really wanted the metal, you could eventually get it. This quiet assumption, that the Git warehouse in the background is always full enough, is what S now being questioned. Over the last 2 years, registered inventories, the category of silver bars actually available to be delivered against futures contracts, at some major exchanges have fallen significantly from their peaks. In London, the world's main hub for vaulted silver, reported stocks have also slipped. Not to zero, not yet, but the trend line is unmistakable. The pile of easily mobilized silver is shrinking at the same time as investor and industrial demand are rising. That's why there are people in this room tonight who would normally be miles away with their families. Representatives from systemically important banks with large commodity operations. Risk officers from funds that hold big short positions in silver as part of complex hedges. Regulators from markets agencies. Central bank officials, whose only direct link to silver is historical, but whose indirect stake is massive. A disorderly rush into hard assets like silver is usually a symptom of something more fundamental, a loss of confidence in currencies, bonds, and the broader financial system. On the surface, this weekend SA's emergency meeting is about a single number on a screen, and the fear that it might flash $80 before anyone has a chance to react. Underneath, it's about leverage, promises, and the suddenly uncomfortable question, what happens if too many people call in the promises at the same time in a market that was never designed for mass delivery? The room buzzes with discrete urgency. Someone calls up a chart of margin requirements on silver futures and overlays it with the parabolic price curve of the last month. Another quietly distributes a risk memo projecting what happens to bank capital ratios if silver opens Monday trading at $60, then spikes to $80 or more on a short squeeze. The numbers aren't existential for the entire system the way subprime mortgages were in 2008, but for a handful of highly exposed institutions, the hit could be life-threatening. A series of questions hang silently over the table. Can they calm this down with rule changes, higher margin, tighter position limits, maybe some temporary trading curbs? Who exactly is short and who is long? How much of the short is legit hedging on behalf of miners and industrial users? And how much is naked speculative exposure that will implode if the price gaps higher? And the most unsettling of all, if someone somewhere is about to fail to deliver metal they sold on paper, can that failure be contained as just another busted trade? Or will it be seen as confirmation that the entire paper-silver market rests on air? No one wants to be the first to say the words, but everyone is thinking them. If the perception takes hold that silver is breaking free from the paper system, and that you need to rush for physical metal while you still can. The chart on the wall isn't just going to show 80. It could print numbers no one in the room has modeled yet. To understand why a spike toward $80 silver would scare people who don't normally care about commodities, it helps to understand what silver actually is in the financial ecosystem. It's not just a poor man's gold trinket that Reddit traders talk about when they're bored of memes. Silver sits at a strange intersection of monetary history, industrial necessity, and financial leverage. For most of recorded history, silver was money. Long before fiat currencies and digital balances, silver coins circulated as everyday currency, while gold coins were reserved for large transactions and savings. The classical gold to silver ratio, the number of ounces of silver you needed to buy 1 ounce of gold, hovered between 10:1 and 20:1 for centuries. Modern markets have been wildly different. Over the last decade, that ratio has often stood between 60.1 and 81, and at times in recent years rose above 90.1, meaning gold was priced at 90 times silver by weight. Those ratios alone don't prove manipulation, but they do highlight an anomaly. Compared with its historical role in relative scarcity, silver has seemed unusually cheap. The world hasn't discovered huge new oceans of silver. In fact, most silver today isn't mined from primary silver mines at all. It's produced as a byproduct of mining other metals such as lead, zinc, copper, and gold. That means silver supply is indirectly tied to the economics of those other metals. If copper prices are weak and copper mines slow production, silver output can fall even if silver prices are strong. At the same time, silver's use profile has changed. It's no longer just coins and cutlery. It's a critical industrial input, especially in the green energy and high-tech sectors. Solar panels use silver for its unparalleled electrical conductivity. Electric vehicles and modern electronics incorporate silver in small quantities across millions of units. Once silver is embedded in these products, much of it is uneconomic to recover. It's scattered into landfills and recycling streams. This is why analysts talk about consuming silver rather than just using it. A significant percentage of what is mined each year effectively disappears from ready circulation. Recent data from industry sources reflect this shift. Annual silver demand from the solar sector alone has jumped dramatically in the last decade, forming a double-digit share of total demand, and is forecast to keep rising as countries chase decarbonization targets. Overall, in several recent years, total silver demand, industrial, jewelry, silverware, photography, and investment, has exceeded mine production plus recycling by tens or even over 100 million ounces. Those deficits have quietly been absorbed by drawing down above-ground inventories. In a world where investors look at charts and ratios, some started doing the math. If gold trades at, say, $2,000 an ounce, and silver trades at $25, that makes a gold-silver ratio of 80. 1. If silver simply reverted toward its long-term historical range relative to gold, some argue, you'd expect something like 30.1 or 40.1. Even if gold stayed flat, silver would need to rise to 50 to 65 just to narrow the gap. If gold itself rose on inflation or monetary concerns, the implied silver price could be higher still. That's not a prediction, but it's the kind of back-of-the-envelope logic that attracts speculative capital, especially from retail investors looking for asymmetric upside. Now, layer on the structure of the financial markets. Modern silver. Price discovery does not mostly happen between a miner and a jeweler in a room with a scale. It happens in derivatives markets, futures exchanges in New York, options markets, and a large opaque over-the-counter, OTC market in London and elsewhere. On COMEX, a single standard silver futures contract represents 5,000 ounces of silver. A trader controlling just 20 contracts is effectively long or short 100,000 ounces, millions of dollars grow worth, without ever touching a bar of metal. This leverage cuts both ways. It allows producers and consumers to hedge price risk cheaply. A solar panel manufacturer, for example, might sell panels forward to customers and buy silver futures to lock in input costs. A miner might sell futures to lock in a price for future output. In both cases, the futures market makes planning easier, but leverage also invites speculation. Funds and banks can build massive long or short positions using futures and options, taking bets on price direction that dwarf the underlying physical flows. Here is where the term paper silver comes in. At any given time, the notional amount of silver represented in outstanding futures, options, and OTC derivatives can be many multiples of the physically deliverable silver registered in warehouses. Estimates vary, can be contentious, but the essential point is not disputed. Far more silver is promised on paper than anyone expects to ever be physically delivered, because the system is designed for most contracts to be settled in cash. Under normal conditions, this is not a problem. Maybe only 1 to 3% of futures contracts go to physical delivery. The rest are closed out or rolled. But imagine a loss of trust in fiat currencies, in banks and promises. Suddenly, investors don't want paper claims. They want actual metal. If that take delivery mentality spreads widely, the mismatch between claims and available bars becomes a structural vulnerability, not just a clearinghouse detail. That's the background context for the weekend meeting. The participants in that room know all of this. They know silver is small in dollar terms compared with global bond or equity markets, but it has outsized symbolic power. A runaway move to $80 silver would be read, fairly or not, as a signal that something is snapping in the monetary system, that people are rushing into tangible assets because they no longer trust paper. And so the suspense isn't confined to commodity desks. It seeps into currency strategy, interest rate policy, and political optics. If silver is screaming higher alongside gold, what does that say about central banks' credibility on inflation? About the perceived safety of government debt when real yields are already contested? The metal itself is just atoms. The meaning attached to its price is what makes people on the 31st floor of this building stare at screens long after midnight, asking themselves whether they are looking at a tradable spike or the early chapters of a systemic story they can't control. The tension that culminates in an emergency weekend meeting never rises from a single day S-price action. It builds in layers, small imbalances, ignored warnings, structural quirks that are manageable until they all push in the same direction at once. To see how an $80 silver scare could materialize, trace the path back over the previous months. First, macro conditions have been deteriorating in ways that make hard assets attractive. Inflation, which was supposed to be transitory, has proven sticky. Even after headline numbers cooled from their peaks, the prices that actually hit households, food, rent, energy, insurance, haven't given meaningful relief. Central banks responded with the fastest interest rate hikes in decades, but governments remained on a borrowing spree, refinancing trillions at higher yields. The debt service burden swelled, and markets began to whisper about a future where central banks might have to tolerate higher inflation rather than crush growth and fiscal solvency. Gold, as expected, reacted first. It crept to new nominal highs as investors quietly diversified out of cash and long-dated bonds. Silver initially lagged, weighed down by its industrial identity. Recession fears mean concerns about lower manufacturing and construction, which usually hit industrial metals. But beneath the surface, something changed. Reports from solar manufacturers indicated no slowdown in orders. Green energy demand stayed resilient, partly because policy mandates, not just market cycles, were driving installations. Several large primary silver mines suffered disruptions. Labor disputes in one region, environmental protests in another, tighter water regulations in a third. None of these events was catastrophic, but together they crimped supply growth just as demand refused to roll over. Then came retail awakening. Echoes of the meme stock era resurfaced, but with more seriousness this time. Influential commentators and niche research shops started pounding the table on silver's structural deficit, its undervaluation relative to gold, and the fragility of the paper-based pricing system. They pointed to charts of London and COMEX inventories trending lower, highlighted the narrowness of the registered category available for delivery, and resurrected old memes about a 100.1 paper-to-physical ratio. Some of these claims were exaggerated, others were grounded in hard data. What mattered was that the narrative caught fire. Coin shops began to see backlogs. Premiums, the amount buyers pay over the spot price for coins and small bars, ticked up, then surged. While spot prices on screens showed, say, $28, retail buyers were paying $34 or $36 for 1-ounce coins. That kind of premium is a classic sign that something is tight in the physical market, even if exchange prices are still calm. Online dealers posted notices about shipping delays. Some temporarily stopped taking new orders on popular products. Industrial users, seeing the same signals, quietly increased their forward purchasing, not wanting to be caught short if supply hiccups worsened. On the futures side, the positioning reports began to show an unusual pattern. Commercials, category often including bullion banks and producers, had large net short positions as usual, but the composition of the long side shifted. Instead of the typical mix of hedge funds trading momentum, more of the open interest was held by smaller players with a stated intent to stand for delivery. Social media campaigns urged traders to take it to them by not rolling contracts, but holding through expiration and demanding bars. At the same time, there were whispers about specific banks being overly short. In reality, a bank's gross short position may be offset by a physical long or OTC long elsewhere. These are complex books with hedges, stacked on hedges. But transparency is limited, and nuance doesn't travel well online. Screenshots of commitment of traders reports were passed around as smoking guns. Whether fair or not, the perception grew that a handful of large institutions were vulnerable to a scramble for delivery. The price action began to reflect this tension. Silver broke through resistance levels that had capped it for over a decade. First $30, then $35. Each breakout triggered algorithmic buying and forced some shorts to cover, feeding the move. Volatility spiked. On days when macro data suggested higher inflation or policy confusion, silver's intraday ranges expanded dramatically. A few trading days saw 10-15% swings. Options implied vol shot higher, making it expensive to hedge. Then, in the week before the meeting, the market started to behave in ways that unnerved even veterans. A large Asian industrial buyer reportedly failed to secure its usual shipment of 1,000-ounce bars at the typical premium. The price they were quoted was several dollars over spot, and delivery was pushed back by weeks. Rumors emerged of a major European refiner telling clients that they were sold out for the next month. London Vault data hinted that inventories dipped sharply over a 2-week span, suggesting a chunky withdrawal by one or more big players. None of these items by themselves was fully confirmed, but together they painted a picture of a physical market that was no longer easily satisfied. On Thursday, silver exploded higher on what looked like a short covering cascade. A large seller pulled bids on the way down earlier in the week, then suddenly stepped back just as aggressive buying hit. The price blew through $35, hit $38, then $40 by the close. Technical traders who had dismissed silver as dead money for years now scrambled to get in. News sites dusted off old pieces about the Hunt brothers' attempt to corner the market in 1980, when silver briefly hit the equivalent of $150 in today's dollars, before regulators stepped in with rule changes that crushed the squeeze. By Friday, the psychology had flipped. A market that had for years struggled to attract attention now felt like a tightly coiled spring. Every uptick attracted fresh leverage. Every downtick was pounced on by dip buyers, convinced that some big reveal about shortages was imminent. Into the close, silver surged again, finishing the regular session above $42. In thin after-hours trading, offers dried up and one spike print flashed above $4,700 before calming down. It was that after-hours behavior, the sense that on light volume the market could jump $5 in minutes, that finally triggered the calls. If this kind of gap appeared in full volume trading on Monday, the risk model suggested forced liquidations could snowball. Highly leveraged shorts might blow up, not because they were evil manipulators, but because their hedges were calibrated for a normal commodity market, not a stampede into physical. Clearinghouses would respond by raising margin calls, demanding more collateral from everyone. At some point, someone wouldn't be able to post what was required, and a default would materialize somewhere in the chain. That is the nightmare scenario the people in the conference room are now gaming out. It's not just the price of silver. It is the prospect of a critical mass of participants simultaneously saying, I don't want a cash-settled contract. I want the bars. In a fractional reserve banking system, a bank run happens when depositors all demand cash at once. In a fractional reserve commodity system, a metal run happens when holders of paper claims all demand metal at once. You don't need a complete collapse for things to get messy. You just need enough strain that someone, somewhere, fails to deliver on time and that failure becomes public. Against this backdrop, the meeting isn't about micromanaging a chart tick by tick. It's about preempting a confidence shock in a corner of the market that, if it spins out of control, could send a message far beyond its market capitalization. The message that, in a world drowning in promises, the people asking for something tangible have the upper hand. Inside the main conference room, the atmosphere has the clipped, focused energy of a war game. The walls are lined with screens displaying live data feeds, open interest by contract month, warehouse stocks by location, options skew, overnight OTC quotes coming in from Asia. On the table are packets of briefing materials summarizing the exposure of key participants: bullion banks, hedge funds, large industrial users, ETFs that hold physical silver to back their shares. One of the first points clarified is deceptively simple. Who exactly is short? Public commentary tends to frame this as a battle between the banks and the people, but the reality is messier. Banks often wear multiple hats. A bullion desk might be short futures on COMEX, but long physical silver in vaults, long forward purchase contracts from miners, and long options elsewhere. Net exposure matters more than gross notional size. Still, as the risk officers go around the room, it becomes clear that some institutions are uncomfortably positioned if silver gaps violently higher. Consider one example, anonymized in the briefings. Bank A has long-standing relationships with several large mining companies. It provides them with price hedging services. When a miner wants to lock in a price for future output, Bank A buys that output forward at a fixed price and simultaneously sells futures to hedge its own risk. On paper, the bank is short futures, but long future physical supply. The trade is meant to be neutral, with the bank earning a spread for its services. The problem arises if the timing and logistics don't cooperate, if there are delays in mine production, or if the miners themselves run into financial trouble and renegotiate contracts. The bank's hedge can become an outright speculative short. Add to that other lines of business: structured notes sold to clients that pay off based on silver prices, OTC swaps with other institutions, and the picture becomes a web of interconnected promises. Under normal volatility, all of this nets out. Under stress, correlation sneaks in where it shouldn't, and what looked hedged can suddenly look naked. Regulators in the room push for worst-case assumptions. What if silver gaps from $42 to $60 at the Monday open? What if it trades as high as $80 intraday before settling? How many institutions would face margin calls they can't meet? Clearinghouses mark positions to market daily. In fast markets, that might effectively happen hourly. Each step higher in price forces shorts to post more collateral. Some will meet the calls, some will not. Someone raises the idea of preemptive margin hikes, making it more expensive in terms of collateral to hold silver futures, especially large positions. There is precedent for this. In 1980, as the Hunt brothers tried to corner the silver market, exchanges increased margin requirements and switched rules to liquidation only for some contracts, meaning traders could close positions but not open new longs. More recently, similar tools were used in other commodity spikes. The logic is clear. By raising the cost of leverage, you force the most speculative players out and hopefully reduce volatility. But there is a trade-off. Implementing drastic margin hikes over a weekend, targeted at a single asset that's suddenly rising, can be seen as a political act, a defense of entrenched interests against price discovery. Retail investors who bought silver believing in a long-term undervaluation will see such moves as proof that they are rigging the game. Trust, already fragile, could deteriorate further. Panic can be fueled not only by prices going up, but by the perception that authorities are panicking behind closed doors. Another option floated is changing delivery mechanisms. Futures exchanges could, in theory, declare that in the case of extraordinary conditions, settlement may be made in cash equivalent rather than physical metal. This would instantly diffuse the threat of a run on warehouse stocks, but at a steep cost. It would essentially confirm that a futures contract is no longer a reliable way to secure actual silver, undermining one of the core reasons the market exists. Investors could interpret such a move as evidence that there isn't enough metal setting off even more aggressive buying in the physical markets, and possibly encouraging wealthier players to bypass exchanges entirely by securing vault space and long-term supply directly from refiners and miners. A central bank official, who has said little so far, finally speaks up. From their vantage point, this is less about silver per se and more about systemic confidence. They draw an analogy to bank supervision. When rumors of a run surface at a particular bank, supervisors have to decide quickly: do they step in with liquidity backstops, reassure the public, and try to calm things? Or do they allow a small failure to occur, hoping it will serve as a cautionary tale without undermining trust in the whole system? In practice, it's usually safer to err on the side of stability, but every intervention creates moral hazard. The same tension exists here. If authorities are seen as bailing out heavily short players or changing rules mid-game, they will be accused of protecting insiders at the expense of small investors who bet on higher silver. If they do nothing, and a cascade of failures and forced cash settlements unfolds, the damage to the perceived integrity of the market could be even worse. Risk models circulate, showing potential spillovers. Some multi-asset funds hold silver as part of broader commodity baskets used for inflation hedging. A violent dislocation could trigger risk parity and volatility targeting funds to delever across the board, selling equities and bonds too. A handful of large industrial users might face margin calls on their hedges right when they need working capital to manage supply disruptions. An $80 silver print is not just a number. It is a pressure test for how much latent fragility is embedded in balance sheets that assumed a relatively placid world. All the while, time is ticking. Asia will open first, and there is no way to fully contain the narrative once markets see whatever price the first thin trades produce. The room debates whether to leak a carefully worded statement, something about monitoring conditions and markets functioning orderly. But such phrases are often read as code for the opposite, saying too little risks, allowing wild speculation, saying too much risks, confirming it. The suspense hangs on a knife edge precisely because there is no perfect move. Any decision, aggressive margin hikes, subtle tweaks, or studied inaction, sends a signal, and in markets, signals can become self-fulfilling. If leveraged shorts believe they'll be targeted by new rules, they may rush to cover in the thin Asian Open, pushing prices higher. If longs fear rule changes that will cap their gains, they may also rush to buy before the door slams shut. Both behaviors drive volatility in the same direction. By the time the main discussion winds down, a loose plan is formed. Margins will be raised, but in 2 steps rather than one shock increase, giving markets time to adjust. Communication will be bland but emphasize that exchanges stand ready to meet delivery obligations with existing stocks. Quiet phone calls will go out to the most exposed institutions, encouraging them to trim positions voluntarily before they are forced to. None of this guarantees a smooth Monday. It merely tries to nudge the path away from the cliff's edge. As the participants file out into the early hours of Sunday, there is no sense of triumph. The numbers don't lie. Inventory trends, demand growth, and years of underinvestment in new supply have made silver structurally tighter than it looks on a price chart. The system can massage volatility, but it cannot conjure metal out of thin air. If this weekend's meeting manages to dodge an immediate crisis, it may simply be buying time before underlying fundamentals force the market's hand. And the screen everyone keeps glancing at flashes numbers that validate what the most alarmed voices have been saying all along. Imagine that despite all the weekend maneuvering, silver does it anyway. Asia opens with a gap higher. European traders, seeing thin offers, push the price further. By the time New York wakes up, the metal is trading above $70. In the frenzy of margin calls, forced buys, and panic covering, an intraday spike prints $80.50s before volatility halts kick in. Headlines worldwide scream some version of the same idea. Silver surges to record highs amid delivery fears. The number $80, once a speculative talking point in niche corners of the internet, is now a historical fact. What would it actually mean? In mechanical terms, an $80 silver price roughly triples or quadruples the value of global above-ground bullion compared with when prices were in the low 20s. If investable stocks are on the order of a few billion ounces, the paper wealth represented by that pile has expanded by hundreds of billions of dollars. Some of that accrues to households and small investors who bought coins and bars over the years and now sit on windfall gains. Some goes to miners whose reserves, revalued at higher prices, make their balance sheets stronger overnight. But the benefits are uneven. Industrial users, especially in sectors with tight margins, see their input costs explode. Solar panel manufacturers, for whom silver is a non-trivial component, have to decide whether to eat the cost, pass it on to customers, or delay projects. Electronics producers lobby for substitutions, looking for cheaper metals or thinner applications. Policymakers who staked climate goals on rapidly scaling solar now face the possibility that one of the key materials has become far more expensive and volatile than their models assumed. Financially, the shockwaves ripple out. Some heavily short institutions take losses large enough to require capital injections or restructuring. Not all of these make headlines. Some are absorbed quietly, buried in quarterly reports as trading losses in commodities. Others are too large or too politically connected to stay out of the news. Investigations are launched into who knew what and when, about inventory drawdowns and concentration of shorts. Hearings feature sharp questions about whether the paper silver market became too leveraged and too detached from physical reality. At the same time, a powerful narrative takes hold in the public sphere. To many observers, $80 silver is less about supply and demand minutiae and more about a verdict on the broader system. In their eyes, the spike is a sign that ordinary savers, frustrated with inflation and financial repression, have voted with their wallets for something they can hold and understand. Commentators draw parallels to past episodes when precious metals surged during crises of confidence. The 1970s inflationary era, for example, when both gold and silver exploded higher as faith in currencies and central bank policy eroded. Central banks, for their part, find themselves in a delicate position. Most of them hold substantial gold reserves, but not much silver. They can ignore silver's price in their official communications. Monetary policy statements rarely mention individual commodities. Yet privately, they know that a runaway move in silver alongside strong gold prices complicates their signaling. If they insist inflation is under control, while markets bid up inflation hedges to the sky, their credibility gap widens. Over the medium term, a sustained $80 silver price would likely trigger a series of adjustments. High prices tend to incentivize supply. Marginal mining projects that were uneconomic at $20 or $25 become attractive at $80, especially if producers can lock in forward prices through hedging. Exploration budgets rise. Juniors with promising deposits see capital inflows. Recycling becomes more profitable. Scrap silver collection increases as it becomes worthwhile to retrieve metal from discarded electronics and other products. These responses, however, take time. Years, not days. On the demand side, industries would search for efficiencies and substitutions. Some applications that use silver because it is the best conductor might learn to live with their habits. Good enough alternatives if the cost differential becomes too large. Jewelry demand tends to be price sensitive. At higher prices, buyers may shift preferences or reduce volumes. Investment demand is harder to model. Some investors will take profits, happy to have seen their thesis play out. Others, especially those who framed silver as a long-term hedge against systemic risk, may hold, or even add, viewing the spike not as a top, but as the market finally blinking in the face of reality. This brings the conversation back to the core financial explanation. An $80 silver episode, especially if associated with delivery stresses and emergency meetings, is primarily a story about leverage and trust. The metal itself did not magically become more useful overnight. What changed is the collective assessment of paper promises versus tangible assets, and the willingness of highly leveraged actors to continue assuming that they could always roll, always settle in cash, always find a counterparty. If such a spike happens without a broad macro crisis, if stocks and bonds remain relatively calm if banks don't experience runs, if currencies don't T-wobble, then history may remember it as a contained commodity bubble that eventually deflated as supply responded and speculative fervor waned. In that case, the weekend meetings and margin tweaks will be footnotes in market structure textbooks. If, however, the $80 silver episode coincides with or foreshadows wider tremors, sovereign debt scares, sharper inflation, political upheaval, it may be seen as one of the early, visible cracks in a financial edifice, stretched by decades of cheap money and rising leverage. In that reading, the drama over delivery and emergency conferences is less about saving a few banks from commodity losses and more about forestalling a symbolic tipping point. The moment when too many people decide that risk-free paper isn't actually risk-free. In either case, the suspense that animates the late-night gathering in that tower isn't just about next week's chart. It's about a deeper uncertainty. How long a system built on confidence derivatives and fractional reserves can function smoothly in an environment where more and more participants from small savers to industrial giants are asking a brutally simple question. If I really want what I've been promised, can I get it? And are no longer entirely satisfied with the answer. That is what makes the idea of $80 silver so potent far beyond its immediate dollar implications. It crystallizes a broader set of anxieties about scarcity, value, and control. Whether or not the metal ever trades there, the fact that serious people feel compelled to hold emergency weekend meetings about the possibility reveals as much about the state of modern finance as it does about a single volatile commodity.